Well, look, I think if you are long equities, you want to be long the big tech companies. I mean, I almost feel like I'm a broken record here, but it's not just the quantity of their earnings growth, it's the quality of their earnings growth. They just keep doing it through every different type of economic and geopolitical condition you can throw at them there. And if you look at the various sub indices, sector indices, Russell 2000, mid cap indices, and so forth. The Mag 6. I'm excluding Tesla from the group. The hyperscalers. They have had the one major sector with meaningful earning PE contraction, and their earnings growth is up 15% year to date, forward earnings growth. Compiled by Bloomberg for the consensus estimate. So I think fundamentally they are really strong. Very interestingly, their capex guidance is up 22% year to date, right, over the next 12 or 24-month period, which is just remarkable given fixed asset growth was not supposed to be robust given all the uncertainty from tariffs and such.
Michael, we've gotten tons of economic data over the last couple of weeks here. How does that inform the Fed's decision here, particularly here as we come up to a September meeting, do you think?
Well, I look, just in the last couple of days, we had a jobs report, we had a manufacturing ISM, we had a services ISM. All three of those reports had some very telling information. I like to look at the 3-month average because it smooths out some of the noise, but it also gives sort of a close enough near and read here. But if you look at the 3-month average of jobs added, that's at 35,000. If you strip out the COVID craziness of 2021, 2021, 22, 35,000 a month is really weak by the low growth periods of 2012 to 2019, let alone for the last couple of years here, right? So that I think is a real concern. The second thing is that the drop in jobs added is one of the most dramatic on record, right? If you just look at the sort of the change in the 3-month moving average. Look at yesterday's print on the services ISM. Look at new orders. They are really at the lowest period, not just for this current cycle, but even going back pre-COVID here, right? Manufacturing, same thing. The employment indices and the services and manufacturing ISMs are sort of confirming what we got on the jobs report on Friday.
It's the first time I've asked this, folks. Let's start strong with Michael Purves. Michael Purves, are we heading towards a 50 beep rate cut? I mean, we got to go to Jackson Hole, folks. Our coverage at Jackson Hole. Joe Weisenthal, Tracy Alloway will be with us.
Is that right?
At Jackson Hole. That's
Hitters.
A good thing. September 17 is the next Fed meeting. Michael Purves, do we need a 50 beep cut there?
I don't think we do, but I would be like right now we're about 90% expected probabilities of a one cut in September. But I think what would the way you could do 50 have the impact of 50 is give it again. Look, if the next jobs report is really bad as well, then I think Powell goes out with a cut, but also a particularly dovish cut. There. I think that's how he squares it. I think there's just too much volatility in the metrics for him to go out with a 50. And look, last September, he did 50, right? That was a surprise 50. And that marked the lows and rates across the curve, not just on the front end, but very meaningfully on the back end, which is what Besant and Trump are very focused on.